Go ahead. Make my day.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. It has been an interesting couple of weeks, folks. More for me than for you, I'm sure. Interesting things kind of going on in the non-real estate related part of my life that could be absolutely redefining in terms of just my life from day to day. As many of you know, I'm a teeny bit superstitious. I don't like to talk much about stuff until it happens. So I'm going to go ahead and embrace. I know I have not embraced that in some cases in the past. Going to embrace it now, but it could be super interesting for me. It could spell even fewer shows here, or perhaps just finally pinning down a regular rhythm to it that is probably a little bit less than where folks want it. I mean, and I really appreciate all the feedback I get from you. I get so many of you asking when the next show is going to be, what's going on, am I okay? So I absolutely appreciate that, and I'm trying to find that healthy place. I had just started a couple of months ago sort of refocusing everything, whether we're talking about this show or my real estate business and other things in my life. And things have taken a very interesting turn where one element could demand a huge amount of my time. So we're going to see how that shakes out. It's not a done deal yet, but we'll see where it points. It's definitely interesting for me. It's definitely kind of a sexy option for me, but it would probably lead to me focusing more on personal real estate investment rather than more than on the ground real estate stuff in terms of my real estate company. It would be me delegating the vast majority of that to the folks on the team. So we'll see how that pans out. At some level, I like doing this stuff. I mean, I like real estate. Real estate is always going to be a huge part of who I am and what I do. It just depends on how many hours in a day I have to do all the various things that relate to it, including this show. So we'll see how things pan out. But I'll give you an update when things are pinned down, when plans are more cast in stone, I guess we could say. But before we talk any more about that, let's talk a little bit about some interesting news in the world of real estate. Today, I want to take a step back and let's look at this sort of approach to real estate. An interesting article came out from the good folks over at protecservices.com. That's PROTECK services.com. We've used their articles before. They tend to be pretty good, a pretty rational organization in terms of analyzing what's going on with real estate. And I don't think they're off the mark necessarily. The article's headline is Home Value Forecast. Don't fret yet. Housing market doomsday forecasts not what they seem. And I think to a certain degree, they're absolutely correct. A lot of this, though, depends on perspective, and we're going to get into that a little bit here as well. But first, let's hit some of the big points here. Now, they're sort of responding to a CBS News Money Watch article, which we discussed, which was titled 3 Reasons to Worry About the Housing Market. I may not have actually mentioned that article directly in the show, but I know we covered the points in it, and I almost always refer to the article, so I'm sure I mentioned it. But it talked about where we are, and what we were expecting. And what I'd like you to do right now for a second is try to, in your head, put yourself in a place where you feel like historically we had a quote-unquote healthy market. What does a healthy market look like? Does it look like it did 1 year before the downturn of 2007, 2008? Is that your idea of healthy? In previous shows, I've argued that's not the case. That the run-up in values was artificial. It was created by generating artificial demand, right, through subprime lending, primarily. And I don't think that's an unrealistic expectation. In fact, given the crazy growth in real estate prices from around 2001, 2002 up until the downturn, something obviously was going on. And my argument has been the big thing going on was easy money. And people being able to borrow just about any amount of money based on then simply saying, oh, yeah, I can cover it. So subprime lending to folks who really shouldn't have been allowed to borrow those sums of money really led to that because it artificially boosted demand. So is that the market we want? You could really almost argue that we haven't had, because the things that fed that stupidity were relatively new, right? They started we've covered this before, but this is granted shows I've done a couple of years ago. But to sort of give a recap, the Community Reinvestment Act, which I believe was passed in 1972, mandated that lending institutions do certain things in terms of being, accepting of different communities and not doing anything with racial bias and all these other types of things. But that law really never had any teeth. In theory, the government could prevent you from expanding, acquiring other banks, because when banks do things, they have to get permission from the government to do that. And the government argued that they could theoretically withhold their permission to do different things if the bank didn't do what the government wanted you to do. Well, in 1995, in Boston, I believe, a bank wanted to acquire another bank. And the government said, hey, you know what? We've looked at your record and we have found that you are not lending to underrepresented communities enough. So we're not going to approve this. And this was the first time since that law had been passed that the government did this. And I think that the banking industry kind of collectively soiled themselves at this idea that, oh, crap, there's a political game we now have to play here. And we can't just go off numbers. We have to lend, as just like you'd have to grease the palms of anyone who wants a good bribe. You have to do these things that don't make financial sense. 1995 is when that court case was decided. And it kind of ramped up a little bit, but it wasn't really till 1999 to 2001 that started to really take off. People started noticing, hey, we can get away with doing this stuff. And because of the way that this was being phrased, in other words, that 1995 decision was you need to lend more to subprime borrowers. And that sort of lit the fire. And everything grew from there. So in your mind, I want you to think, given, and assuming I'm correct, I've talked to a couple of you who don't entirely agree with me. I think it's a hard one to argue, particularly when you start getting into things like when we securitized loans, right? When we created these big investment things to invest in subprime loans. What was the source of that? Well, it wasn't the source of a rational lending institution. It was the source of Fannie and Freddie and government institutions that got together with banks and said, let's make these things. And they did, which made things worse. So what's healthy? Is the healthy place the peak before 2008? Or is the healthy place somewhere further back? So keep that in your head as we read these numbers, because one of the things that's always frustrated me about where we are is that people say we need to get back to a normal market. Okay, when was that? Where was your normal market? 2005. Okay, well, do you know what the lending world looked like in 2005? Do you know how artificially bloated the lending world was? How artificially bloated the number of buyers was in 2005? Is that really what you consider a healthy marketplace? Because I don't. I honestly think you have to go back to the mid to late 90s before you can find a rational lending place as it relates to homes. Now, there's always going to be ups and downs, but when there are ups and downs married with stupid lending policies, it exacerbates the problem. It makes it worse. It creates a wider crater of damage when you've facilitated all these people taking on more of an encumbrance in terms of debt than they can reasonably maintain or sustain. Okay. So with that in your head, now keep that in the back of your head as we read this, because they're going to attack this from a few different areas. The original article that they're kind of responding to cites affordability, sales activity, and demographic trends as reasons to worry. And they kind of go along that same line and try to take it apart a little bit. So their first point is affordability. After the 2008 crash, affordability was artificially high due to foreclosed properties flooding the market and historically low interest rates. Overall, affordability is returning to pre-cat crash norms. Pre-crash norms, which is a little bit scary because what is normal to them? Now, if you look at the chart they're talking about, they have a household financial obligations as a percent of disposable personal income chart, and we're actually pretty dang low. The level we're at is down closer to 1995 levels, lower than what it was in the early 2000s. The only place where it's lower than where we are now is going all the way back to the 80s, like between 1980 and 1985. So that's actually not a bad thing, right? Because remember, we're talking about household financial obligation as a percent of disposable personal income. So that's actually pretty good. And they don't seem to be in this referring to the time period just before the downturn, right? At the peak, it was 18% of household financial obligations as a percent of disposable personal income just before the downturn was at just over 18%, and then it immediately cratered and dropped down to 17.5, then jumped back up to about 17.75, and then just crashed in 2010, and by 2011 and 12, it was down around 15%. And of course it was, right? Because that was us recovering from the downturn, tons of foreclosures, tons of affordability. We're up from that. We're up to that 15%, but we're only at 15.75. We're under 16%. Now remember, this is national. So, and the reason why I want to point that out is there are still areas of the country where this is absolutely not true, where there are people where their household financial obligations is closer to 30% or 40% of their disposable personal income. So keep that in mind. But this makes a really good point. As a national average, we're not doing so bad in terms of percent of disposable personal income. So while it is different, it's not bad. It was much worse from 1995 up to 2008, 2009, right? So good. On that score, I think they're absolutely right. The last sane time, now remember, we also had a huge peak between 1985 and 1990 where it went up to 17.5% for, it looks like 86, 87. And then did a little bit of a drop down to just below 17%, kind of stayed flat for a little bit. And then just after 1990, dropped back down to about 15.6%. So some variation there depending on downturns, right? And what's also interesting here is they mark out where different downturns were. You know, in 1990-91, we had the savings and loan scandal, and then you see the big drop in what it was costing in terms of percentage of disposable personal income. So those are all interesting numbers, easy to explain numbers. But what's also interesting is we have not gotten up to percentages anywhere near where they were just before the downturn. And I think that's great. So when they're referring to quote unquote normal, it sounds like they're talking about my kind of normal, pre-crash normal for them in terms of the numbers where we're at right now is still hovering right around mid-90s type numbers. So on that score, we're actually pretty good. Affordability is actually not that bad. Now, of course, all of that hinges on disposable personal income. So then the argument that I've made before that employment plays such a big part comes into it. And where are we today? Last numbers I read said that we have the best unemployment number since 1960, 1959, somewhere in that range. Let's see. For the 25 metros that they looked at, peak home prices before the crash, what that equates to in 2018 dollars and the current average home price. More than 11 years later, 8 out of the 25 metros are still below pre-crash peaks. If you had a cost of living adjustment, 16 of the 25 metros are below pre-crash highs. The 9 metros that are at new highs, Atlanta, Charlotte, Dallas, Denver, Houston, Portland, Oregon, San Antonio, San Francisco, Seattle, are experiencing rapid growth in their business base. Pre-crash, 14 of the 25 metros had an affordability index under 100. Today, there are only 4, Los Angeles, Miami, San Francisco, and Seattle. So in all of those numbers, things aren't looking too bad. Now, the Collateral Analytics Affordability Index used by Home Value Forecast also looks at loan-to-value norms for a particular area to adjust for more affluent buyers usually putting more money down. Of the 25, only one metro, Denver, has an affordability index lower than before the crash. As we discussed earlier in the data we were talking about before, San Francisco has the lowest affordability. And while this is low, it's still not like the bubble territory of 1989 or 2007, which is absolutely true. All right. So in terms of affordability, we're actually not doing that bad. So reason for confidence, right? Next, they wanted to discuss was sales activity. The article that they're referring to shows how the average price for newly constructed homes has gone up while the number of units has gone down. Both are true statements. Quote, large single-family developments are still being built, but at a slower pace. More building is being done in cities, both single and 5+ unit structures, where existing dwellings are either torn down or rebuilt. To make a profit, these new dwellings have to be at a higher price point, something we've seen happening in Nashville and San Francisco. In terms of building patterns, single-family housing starts have been lagging. So that's something we've been talking about. And if you go for privately owned housing starts, one-unit structures, and this is a chart we've talked about tons. We've been talking about it since probably 2013, 2014, where we are nowhere near where we were at the peak. It's an interesting chart to check out. I would strongly suggest you go to the link, protechservices.com, and check it out. How negative market forecast missed the mark. Go ahead and find that article, and you can see this chart where we're nowhere near single unit construction that was at the peak. Nowhere near. In fact, going all the way back to 1999, we are below the build rate all the way back to then. And that's as far back as they go on this chart. I'm not sure how far back you'd have to go, but it's probably at least 20 years, if not 30 years. So as we've talked about before, this should not surprise you. If you've been a listener to this show, you know that we've talked a lot about we just have not stepped up in the terms of the number of homes that were being built. And for those homes that were being built, they tended to be at the higher end. And one reason why we explained that was that the amount of regulations that got heaped on building just from the year 2000 has been ridiculous. It's been discussed that, say, 30 to 35% of what you're paying in a house relates to those regulatory costs that have just been incurred since the year 2000. And the argument I've made is, do you feel like your home is safer than a home built in 1999, right? Do you feel like regulations that have been put into effect since the year 2000 have made your home so much better than what a home would have been like if it was built in 1999 that it's worth paying an extra $30,000? So that $100,000 home becomes a $130,000 home just because of those regulations, right? And my argument's been that that's ridiculous. If we wanted to be sane, we would cut all the rules that were enacted after 2000 and stick with those if we wanted to really make a smart move in real estate. Okay. And then, of course, if we look at privately owned housing starts with 5-unit structures or more, we saw a huge dip between 2007 and 2010, where then it started to ramp back up. And now we are going all the way back to 2000. We are at highest levels of multi-unit. So as we've argued again on this show, a great deal of what was being built was multifamily, 5 units or more, right? So not duplexes, not tris, not quads, 5 units. So we're basically talking apartments. That's been predominantly what's been getting built. And we are at numbers exceeding the highest that's ever been since at least the year 2000, which is as far back as this chart goes. So I think you could argue that in terms of sales activity, it has a lot more to do with simply what's been getting put on the market rather than anything relating to supply and demand. Supply has been kind of artificially suppressed, right? And not artificially suppressed in terms that the government's come in and done anything, or maybe you could argue that government intervention has encouraged folks to do either high-end or multi-unit development simply because you get bigger bang for the buck, and you need that bigger bang for the buck to compensate for regulatory costs. You could argue that. I mean, there's absolutely room for that argument. But the reality here is that it has disconnected, whatever's going on, it has disconnected the demand, the true demand of what people are looking for from the folks who are creating the product that people are trying to consume. Next on their list was demographics. They talk about the article this way, saying the article ends with a look at millennials and suggests that the longer this generation delays home ownership, the more baby boomers looking to downsize will be pressured into lowering their home prices when they enter retirement. One could reason that this could impact the affordability issues referenced earlier in the piece. In closing, home value forecast does not see storm clouds gathering. Instead, we see a return to market fundamentals where home prices are driven by supply and demand, not overly influenced by a wave of foreclosures and its lingering impact. So yeah, and we've talked about that before, right? On a couple of shows we've done in the last month, we've talked about the baby boomers, and we've talked about how bankruptcies, they're the largest group engaging in bankruptcies at a rate unheard of for their age group, which encourages them likely to retreat from home ownership, take the value out of their property, and potentially rent. And we've talked about different markets where you would benefit from that if you're someone who is renting to that particular demographic segment of the market. But as this article points out, what they see is a return to market fundamentals, where supply and demand are a little bit more of the driving factor behind things, where they see a group potentially stepping up as sellers that are likely to then sort of refill the marketplace with a supply that can come closer to meeting demand. And the other thing that is interesting to note is on the demand side in a lot of markets, we've seen that decrease. We've seen it in the South. We've seen it where buyers are now sort of in the driver's seat in a lot of markets in the South. We're seeing here in my marketplace, we're still seeing multiple buyers per home, but we're just not seeing the same number of multiple buyers. In markets like mine, it's more about a slowdown in the growth of prices rather than a freeze in the growth. So no one's talking about prices declining in my market because they really aren't. With the possible exception of some submarkets, which could absolutely be true. We're close enough now that I could actually see that happening in some markets, particularly some luxury markets. But in general, what we're seeing is instead of seeing 7%, 8%, 9%, 10% in some markets, you might see 2%, 3% increases in values over the course of a year. Right now, I think Zillow is saying my home is supposed to experience a 3% increase. So still an increase. Of course, Zillow is when giving specific values of homes, maybe a little bit wonky, but when it gives generic, in your region, we expect to see this amount of increase in property values. When you're not talking about a specific home, Zillow can oftentimes be pretty accurate. When you're talking about entire regions, when you're talking about an individual home, not so accurate. When you're talking about wider regions, they tend to be a little bit closer to the mark. It's just when you get into super specifics that I think Zillow kind of drops the ball. All right. So what's the takeaway? We can talk about an awful lot of things going on in the marketplace that are not great. Things that should be concerning, things that could drive another downturn. All of those things are absolutely true. I don't think we can discount what folks are saying who have been smart in the past about this. Peter Schiff, others that are saying anywhere from the middle of 2019 up through 2020, likely to see a downturn in that time frame. I don't think that's an unreasonable thing to expect given the debt. Now, one other thing that's happened recently, if you want to just sort of get bigger picture about it, and this is what's so frustrating, right? Because Republicans are in charge of everything. And they're supposed to be the fiscally responsible party, or at least that's what everyone says, right? Well, so their debt and deficit spending is now the highest. They've broken all the records of everybody before them. So they simply built on the same poor spending policies of the previous administration. Blowing away tons of money now, and I'm all for tax cuts, but tax cuts have to be married with budget cuts, right? You can't do tax cuts and then not cut the amount of money you're spending as a government, and they haven't done that. So it's just crazy. In fact, I believe I read an article that said if we took $130,000 from every single man, woman, and child in the United States to contribute towards the deficit, that still wouldn't pay it all off, and even if it got really super close and we could consider it at zero, it would only take 2 years to get to the same deficit we're at, given the spending that we currently embrace. So those are nuts. And you mix that with numbers on pensions and some of the things we've talked about that are going on in California with new rules and regulations that are really going to alienate business. There's a lot of stuff going on that we should all be worried about that are not good things. So the idea that there could be a huge downturn, and the other thing is the cyclical nature of the economy. We're at a place where it's super reasonable, even if you're just betting on the odds, it's super reasonable to expect that we will have a downturn, right? We're actually late for one. You could argue that we've sort of been slogging through a downturn that wasn't just isolated to 2007 to 2010. You could argue, a lot of folks could argue that we've really been in it for 8, 9, 10 years. And only kind of creeped out of it a couple of years ago. But still, it's been, 10 years since the last big downturn started? So where does that leave us in terms of estimations? I still think it's wise for us to have backup plans to be prepared. I think anytime that rocky roads are ahead, and I think that's a logical thing to expect, it's smarter to take the attitude of, I want to have a bigger cushion. I want to invest smarter. I want to try to invest in more stable areas. I want to be able to adapt to a downturn and not have to give up my properties. So maybe that means I consolidate in some areas. Maybe that means I go for the most overpriced properties that I currently own and I sell those and invest those maybe in some properties that'll cost me the same or less now, but are in areas that are more stable. And that's, I think, all any of us can do. Not awesome, great news. This should allay some fears that things aren't ready to simply fall off the cliff. The numbers in terms of affordability, I think, are really the most convincing in this particular article. And again, you can check that out for yourself at protechservices.com. Hey, I really appreciate you all taking the time to listen to the podcast. Of course, the goal is to always leave you with more information on the table than time you spent listening. Hope we've achieved that today. Thanks again, and I'll talk to y'all next time.